welcome John Schindler, Secretary General of the Financial Stability Board, the global body responsible for monitoring and strengthening the international financial system. The FSB is operating in the context of evolving risks and a challenging global economic outlook, so we look forward to hearing your insights and perspectives today.
Great, thank you. And good morning, everybody. Thank you to Frederick and for the Insurance Europe for the opportunity to come and address you today, this very distinguished group of representatives from the insurance industry. I want to start by going off script very briefly. My comms people are not here, so they won't yell at me, but when you invite the Financial Stability Board to come and speak, you're inviting a group that thinks about nothing but risks and all the bad things that can go wrong. So I would usually tell you, don't invite us to speak at the very beginning, because then the whole day is just sort of tainted. But your organizers said at the beginning, well, we're insurance folks. That's what we do. We think about risks all day. I was like, well, I fit in here perfectly. This is great. So thank you for this. The theme of this year's conference, Building Resilience in an Uncertain World, couldn't be more timely, as you all know. We're currently facing profound shifts in our global landscape, including geopolitical, economic, environmental. These changes bring with them both challenges and opportunities, and they underscore the critical importance of resilience, particularly in the financial and the insurance sectors. So today, what I'd like to do is share some thoughts on the current geopolitical and economic outlook, the evolving risks that we're all facing, and the pivotal role that the insurance sector can play in strengthening global resilience. So let me begin by addressing the broader context in which we're all operating. I have some slides. I'm not going to speak to the slides, but they're designed so that you don't have to stare at me for 15 minutes. So, you can look back and forth as you wish. The ongoing conflict in Iran has introduced a significant degree of uncertainty into the global economic outlook. The disruption to the supply of oil and other commodities has led to higher and more volatile energy prices, raising concerns about a stagflationary shock to the global economy. This, in turn, has fueled bond market volatility as inflationary pressures impact investors' expectations of central bank rate increases. While the current effects are macroeconomic, the ultimate impact on financial stability will hinge on the duration and the severity of the disruptions to commodity supplies and global markets. The FSB is closely monitoring these developments for any indications of strain in the resilience of the global financial system. At the same time, financial markets appear to be optimistic, at least from my perspective, given the uncertain economic and geopolitical backdrop. Overvalued and stretched asset prices leave markets vulnerable to sharp downward adjustments, and we've already witnessed corrections in certain market segments. For instance, bond markets have seen significant movements as concerns about inflation and sovereign debt levels have come to the forefront. Such volatility has the potential to exacerbate existing vulnerabilities in sovereign debt markets, where risks are already elevated. Heightened investor concerns about debt sustainability could exacerbate refinancing challenges for governments. And as we've seen in past episodes, stress in sovereign debt markets can spill over to the broader financial sector, amplifying risks to financial stability. The increasingly interconnected nature of the global financial system means that vulnerabilities in one area can quickly propagate to others, and it can do so in new ways that we haven't experienced before. This underscores the importance of vigilance, coordination. Frederick referred to teamwork, coordination, teamwork, all the same, and proactive risk management to ensure that the financial system remains resilient in the face of these evolving challenges. So let me share a few areas, in fact, just two areas where the FSB is watching particularly closely right now. A little bit more on sovereign debt markets, and I'll talk a little bit about private credit. First, on sovereign debt markets. These are increasingly vulnerable due to the growing prevalence of leveraged bond trading strategies. These strategies are employed by some hedge funds and some other market participants looking to profit from arbitrage opportunities in government bond prices and the associated derivatives. As highlighted in the FSB's recent report on vulnerabilities in government bond-backed repo markets, hedge fund cash borrowing in repo markets has increased over the past few years and now amounts to $3 trillion or about 25% of their assets. If the strategies face rising repo rates, higher haircuts, or increased margin requirements, they could be unwound quickly with destabilizing effects on market dynamics, especially during those times of stress. Similar dynamics contributed to the significant market dislocations in March 2020. These developments underscore the importance of maintaining robust risk management practices and ensuring that sovereign debt markets remain resilient in the face of rising challenges. Now, the insurance sector has an important role to play in managing these risks. Insurers, I'm talking to an audience that knows this very well, are significant investors in sovereign debt, and your investment decisions can have meaningful impacts on market dynamics. With your long-dated liabilities, your structurally large allocations to sovereign debt, insurers are well positioned to act as those patient, stabilizing investors in government bond markets, a role of growing importance as others pursue these shorter horizon, leverage-driven strategies. But the stabilizing function performed by long-term investors shouldn't be assumed. The 2022 gilt market turmoil, which was driven primarily by pension funds and liability-driven investment strategies, illustrated a broader mechanism that may be relevant to institutional investors with significant fixed income exposures and derivative overlays. Under stress, collateral demands and margin calls can compel asset disposals at precisely the moment that markets are most fragile, transforming a structural buyer into a seller and a source of amplification. While insurers operate under more stringent liquidity and capital frameworks, ongoing supervisory focus is necessary to ensure that the sector's stabilizing role in sovereign debt markets is durable. This includes areas such as collateral management, derivatives exposures, liquidity preparedness for those stress scenarios to ensure that we have this resilience during periods of stress. Let me turn to private credit. The FSB defines private credit, and it's very important to state your definition at the beginning because there's no single definition of private credit. We define it as non-bank direct lending to medium-sized companies negotiated on a bilateral basis. This financing serves as a vital source of diversification and innovation in financial markets. It bridges financing gaps, offering solutions to companies that may be underserved by traditional banks or public markets. Private credit provides faster execution, more tailored structures, longer-term capital commitments, and greater flexibility for borrowers who have complex or unconventional needs. It also plays a crucial role in supporting emerging industries, such as artificial intelligence, by providing the debt funding that is needed to fuel their growth. The growth of private credit has been remarkable. In the past decade, the sector has expanded with total assets now between $1.5 and $2 trillion at the end of 2024 across the jurisdictions that contributed to the FSB's recent study. However, some alternative estimates are much, much higher. You've probably heard some of those numbers. Private credit is expected to continue growing as companies seek alternative sources of financing. However, alongside these opportunities, private credit introduces a complex array of new questions and vulnerabilities that warrant closer examination. Interconnection between private credit funds, the banks, the insurers, private equity firms are deepening, and this is raising concerns about potential spillovers in times of stress. Our recent report on private credit highlights several key vulnerabilities arising from the interlinkages with banks, from borrower credit quality, and from valuations. Importantly, the market remains untested at its current scale. I'm not hoping that it gets tested, but it hasn't been tested so far. And data gaps mean that authorities do not have full visibility or full understanding of potential channels of contagion. Our report also underscores the interconnectedness of private credit with the insurance sector. Insurers and pension funds are key investors in private credit, with their activity in this asset class having grown recently. For example, insurers in multiple FSB jurisdictions have seen increasing investment in these private assets, and certain large private defined contribution pension funds and superannuation funds have increased their allocation to illiquid private equity and credit in recent years. Private equity funds appear to be another interconnection. Private equity sponsors typically back borrowers in private credit and also appear to be increasingly developing ownership or control relationships with insurers, which are then used to invest in private credit funds. In addition, private credit issuers rely on private credit ratings that are sometimes provided by smaller and lesser-known agencies. These ratings are important, for example, to some investors like insurers, but the use of lesser-known agencies has also raised questions. And then another consideration related to these interlinkages relates to cross-border issues, where international capital flows and the various diverse market structures that exist around the world could expose further vulnerabilities and propagation channels. Now, these concerns are not about private credit as an asset class, but rather about how private credit might behave under stress and the potential risks with that. Indeed, some prominent financial sector experts have also raised alarms about these vulnerabilities. Addressing these vulnerabilities will require greater transparency, improved data collection, and enhanced regulatory oversight. The FSB in our report has outlined 3 areas for follow-up work. First, deepening analysis of the interlinkages and potential vulnerabilities related to liquidity mismatch. This includes examining ties with private equity firms and insurers and understanding potential issues related to liquidity mismatch in certain private credit funds. Second, improving transparency in order to address data gaps, enhance reporting frameworks, and develop harmonized global definitions to support effective monitoring. And then third, sharing supervisory approaches in order to strengthen risk management and governance practices for both banks and non-banks that are active in private credit, particularly around the valuations and the use of private ratings. Now let me turn for a few words on other FSB work related to the insurance sector. I think it's obvious that the insurance sector is not immune to any of the trends that I've been speaking about or any of the vulnerabilities I've been describing. And I think, in fact, right now the insurance industry sits at the intersection of many of these challenges, like the growing complexity of financial markets. But insurers may also be directly exposed to some challenges, like climate change and aging populations, more so than other parts of the financial system. Addressing climate-related financial risks is an area where the insurance sector plays a particularly critical role. The increasing frequency and severity of extreme weather events, and the weather has been pretty warm recently. I'll let you determine whether that's global warming or not. In areas where you have no air conditioning, like where I live right now, it can be particularly hard felt. These events have highlighted significant protection gaps in many parts of the world. And these gaps leave individuals, businesses, and governments vulnerable to the financial impacts of these climate events. Closing these protection gaps will require innovative solutions, including new insurance products, enhanced risk modeling, and greater collaboration and teamwork between public and private sector stakeholders. The FSB will continue to support these efforts, including through our work on climate-related financial disclosures and our collaboration with the IAIS. Another area of focus is the resilience of the insurance sector itself. The FSB, in partnership with the IAIS, has made significant progress in developing guidance related to insurer resolution. In April, the FSB published its final guidance for authorities to assess which insurers should be subject to recovery and resolution planning requirements. The guidance outlines six key criteria that authorities should consider: the business model or the nature of the insurance business, scale, complexity, substitutability, cross-border activities, and interconnectedness. Additionally, it specifies specific circumstances in which recovery and resolution planning requirements should apply, such as when an insurer provides a critical function or when its failure is likely to have a material impact on the financial system and/or the real economy of the jurisdiction. This is intended to align with the requirements in the IAIS insurance core principles. The FSB's decision to move beyond the global systemically important insurer framework, the GSI framework, in favor of the IAIS holistic framework for assessing systemic risk in the insurance sector reflects our recognition of the sector's unique characteristics and the need for tailored approaches to addressing systemic risks. So to conclude, while the challenges before us are undoubtedly formidable, they are far from insurmountable. The global financial system has shown remarkable resilience in weathering recent periods of financial turmoil and stress, and I'm confident that it possesses the strength to navigate the challenges of the present and the future. The insured sector plays a critical role in fostering systemic resilience. Its ability to adapt to evolving risks and support economic stability is vital to a proper functioning financial system. The FSB's aim is to ensure that the sector remains robust and resilient precisely because of its importance to the financial system and the economy. The FSB is committed to doing its part. We will continue to monitor developments closely and advance our work in key areas, including private finance and credit markets, as I mentioned, foreign exchange derivative markets, and the growing complexity and interconnectedness of the financial system. We will also deepen our collaboration with the IAIS and other international bodies to ensure that the insurance sector remains a pillar of stability and resilience. While the road may be uncertain, it's full of opportunity, and the insurance sector, with its unique capacity to manage risks and support economic stability, is an indispensable pillar of the financial system. By working together across sectors and borders, we can ensure that our financial system remains robust and adaptable, prepared not only to weather future shocks, but to enable sustainable growth and prosperity for everyone. Thank you very much.